studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
When a corporation generates a non-capital loss, the work doesn't end after calculating the amount. One of the most important responsibilities of a tax professional is to track that loss accurately over multiple taxation years. Every dollar of the loss must be accounted for, because it represents a valuable tax asset that can reduce taxes either now or in the future. Think of a non-capital loss as money stored in a tax savings account. The corporation may not use the entire loss immediately, but the unused portion remains available for future tax planning. To make sure this asset is managed correctly, accountants maintain detailed records of how much loss was created, how much has been used, and how much still remains. In this example, the corporation incurs a non-capital loss of $80,000 during the 2024 taxation year. Once the loss has been calculated, it is recorded in the corporation's tax records and becomes part of its loss pool. This pool represents all available non-capital losses that may be applied through a carryback or a carry-forward. Schedule 4 plays a central role in this process. It serves as the corporation's official loss tracking schedule. Rather than simply showing the current year's loss, it maintains a history of the loss by recording the opening balance, any amounts applied to other taxation years, and the remaining balance that is still available for future use. Accurate tracking is essential for several reasons. First, it prevents the same loss from being claimed more than once. Second, it provides clear documentation if the Canada Revenue Agency reviews the return. Third, it helps maximize tax savings by ensuring that every available dollar of loss is used correctly. Finally, it maintains continuity from one taxation year to the next, allowing future tax returns to build on accurate historical records. The overall process follows a logical sequence. The corporation creates a non-capital loss during the current year. That loss is recorded in the loss register and Schedule 4. It is then tracked across future years until it is either carried back, carried forward, or fully utilized. After each application, the remaining balance is updated so the records always reflect the amount still available. Professional accountants understand that calculating the loss is only the beginning. Maintaining accurate records year after year is equally important. Good documentation ensures compliance with the Income Tax Act, supports the figures reported on future tax returns, and protects the corporation during any CRA review. The key takeaway from this slide is that every non-capital loss is a valuable tax asset. To preserve that value, accountants must carefully record, monitor, and update the loss every year using Schedule 4 and supporting tax records, ensuring that no portion of the loss is lost, overlooked, or claimed twice. Now let's see how a non-capital loss is actually applied across multiple taxation years. This step is extremely important because accountants must keep track of exactly how much of the loss has been used and how much still remains available. Good tax planning depends not only on calculating the loss correctly, but also on maintaining an accurate record of its utilization over time. In this example, the corporation generates a non-capital loss of $80,000 during the 2024 taxation year. Since the corporation paid taxes in previous years, it decides to carry this loss back to recover some of those taxes. The process begins with the most recent prior taxation year. In 2023, the corporation reported taxable income of $30,000. The first $30,000 of the loss is applied against that income, reducing the taxable income for 2023 to zero. Because taxes had already been paid on that income, the corporation becomes entitled to a tax refund. After this first application, $50,000 of the original loss remains available. Next, the remaining loss is applied to the 2022 taxation year. That year had taxable income of $20,000. Another $20,000 of the loss is used to eliminate that taxable income. Once again, the CRA recalculates the taxes for that year and refunds the excess tax that had previously been paid. At this point, $30,000 of the original loss is still available. The process continues with the 2021 taxation year. That year had taxable income of $15,000. So $15,000 of the remaining loss is applied. This reduces the 2021 taxable income to zero and generates another tax refund. After completing all 3 carryback applications, $15,000 of the original loss still remains unused. This remaining balance is not lost. Instead, it becomes part of the corporation's non-capital loss pool and is carried forward to future taxation years. When the corporation earns taxable income again, this remaining $15,000 can be used to reduce future taxes. Throughout this entire process, Schedule 4 acts as the corporation's official tracking record. It records the original loss created during the current year, the amount applied to each previous taxation year, and the remaining balance after every adjustment. This ensures complete continuity from one tax year to the next. One of the most important rules to remember is that after a portion of the loss has been applied to a taxation year, it is no longer available for future use. The remaining balance must always be reduced after each application. Using the same loss twice would result in an incorrect tax return and could lead to adjustments by the Canada Revenue Agency. The key takeaway from this slide is that loss carrybacks are applied 1 year at a time, and after every application, the remaining balance must be updated. Professional accountants carefully track every dollar of the loss to ensure that Schedule 4 remains accurate and that future tax returns continue with the correct opening balance. As we conclude this example, it's important to understand that most problems involving non-capital losses are not caused by incorrect calculations. Instead, they are caused by poor record keeping. Even if the loss is calculated correctly, failing to track it properly from year to year can result in costly errors on future T2 corporate tax returns. One of the most common mistakes is using the same loss more than once. Once a portion of a non-capital loss has been applied to reduce taxable income in a particular year, that amount has been fully utilized. It can never be claimed again. If the remaining balance is not updated correctly, the corporation may accidentally claim the same loss twice, resulting in an incorrect tax return. Another common error is forgetting about previous carrybacks. A corporation may have already applied part of its loss to earlier taxation years and received tax refunds from the CRA. If those prior applications are overlooked, future tax returns may incorrectly assume that the full loss is still available. This leads to inaccurate loss balances and possible reassessments. Incorrect remaining balances are another frequent problem. Every time a loss is carried back or carried forward, the available balance must be reduced immediately. The opening balance for the next taxation year should always reflect only the unused portion of the loss. Maintaining this continuity is essential for accurate tax reporting. Poor documentation can also create serious difficulties. Professional accountants keep detailed schedules, calculations, working papers, and supporting records for every loss claim. These records provide evidence of how the loss was calculated, where it was applied, and how much remains available for future years. Equally important is updating Schedule 4 every year. Schedule 4 should never be viewed as a one-time calculation. Instead, it serves as the corporation's ongoing loss register, recording opening balances, current year losses, carrybacks, carryforwards, and remaining balances from one taxation year to the next. Experienced accountants also verify their records by reviewing prior year notices of assessment issued by the Canada Revenue Agency. These notices confirm the losses accepted by the CRA and the amounts applied to previous years. Comparing internal records with CRA assessments helps identify discrepancies before they become larger problems. If we follow the complete workflow, the process is straightforward. The current year's loss is calculated and recorded on Schedule 4. Any carrybacks are applied to prior taxation years. The remaining balance is updated immediately after each application. That updated balance then becomes the opening balance for the next taxation year, where the process continues until the loss has been fully utilized. This disciplined approach protects the corporation from errors, supports CRA reviews, and ensures that every available dollar of tax savings is preserved. Accurate tracking also makes future tax planning much easier because the accountant always knows exactly how much loss remains available. The key takeaway from this slide is that professional accountants do much more than calculate non-capital losses. They maintain a complete history of every dollar created, every dollar claimed, and every dollar still available. Careful record keeping, annual Schedule 4 updates, and proper documentation are what transform a simple tax calculation into sound professional tax practice.